Hey everyone, how's it going? It's Dan Russo, the Chief Market Strategist at Chaikin Analytics. Hope everybody's having a great Wednesday morning. A little bit of a dreary day here on Long Island, but I wanted to come to you nonetheless with some updated thoughts, what's on my mind here pre-market on a Wednesday morning. So for me, what I've really focused on over the past couple of days is this backup in interest rates, in particular from the 10-year out, right? So the long end of the curve, right? So we've been talking for some time about the curve and how it's been steepening. As a matter of fact, we started writing in early June about how we thought it makes sense for people who were invested in treasuries to start to favor shorter durations. And that's continued to play out. But today, what I'm really interested in and what I've been focusing on is what that could potentially mean for the equity markets. Now, I look at a large basket of equity ETFs to get a sense for what's going on with the market. And I dug in and I looked at some correlations. 63 days, so roughly one quarter correlation of the 10-year yield to these different areas of the equity market. And a couple of things jumped out at me. First and foremost, all of the major ETFs that I look at are actually positively correlated over the past 63 days with interest rates. So they've kind of been moving together. Now the correlation is not tight. At the highest level, it's the mid 30s. And at the lowest level, it's high single digits. But what jumped out at me was at the lowest level, the bottom three are actually growth-oriented ETFs. So I started to unpack that a little bit. I started to think about what that could mean if rates continue to rise. Now, I don't think rates are going to rise substantially, just given the Fed's stance on interest rates. But with the 10-year yield at 80 basis points, what would happen if it were to go back to where it was prior to the big drop caused by COVID and that acceleration to the downside? Well, that would actually be a doubling from here. They were at about 1.6% prior to that acceleration to the downside. And I kind of started to think about what that could mean for certain areas of the market, in particular in the equity landscape. And for me, it's interesting because I think it could have the most negative impact on a lot of the high-flying story stocks that people are always focused on, and rightly so. Everybody loves a good story and everybody likes to pay attention to the fast growers. But a lot of times what happens with these fast growers is they're not profitable, and some of them are not even cash flow positive. So essentially what you have is a situation where profitability and cash flow are out in the future. So if you just kind of think in time value of money terms, right, if your cash flows are further out in the future and now you're discounting them at a higher rate, that is going to lower the present value of those future cash flows. So all else being equal, I think it makes sense for investors who are keenly focused on these high-flying growth stocks and these growth areas of the market to really be paying close attention to what's happening with interest rates. Now, again, there's a lot of moving parts here, and this is only one dynamic, which is why I say all else being equal. But all else being equal, if you are discounting future cash flows at a higher interest rate, the present value is lower. So something to keep in mind. I think that if you are focused on these high-flying growth stocks, that you really should be paying attention to what's going on in the interest rate market. Now, I always think you should be paying attention to what's going on in the interest rate market, but more so now for the potential impacts as it relates to equities. You might not be invested in or trading fixed income products, but I do think it makes a ton of sense to be paying attention to what's happening there. So those are my quick thoughts at a high level as it relates to interest rates. We're going to start to see, I think, a lot more commentary about the fact that they are moving higher. Now, what happens, should we get a stimulus bill? Are rates moving in anticipation of getting a stimulus bill? I don't know, but I'm certainly going to be paying attention. To me, on the 10-year, the key level right now is 90 basis points. I think a move above 90 basis points opens the door for further upside in rates. Another thing that's on my radar screen this morning, the dollar. Taking a look at the dollar index, it actually is breaking down here a little bit in the near term. I've said before that I think the dollar is one of, if not the most important charts to be paying attention to in the market. Obviously, we want to add rates to that list now as well. But the dollar breaking down has implications for other asset classes as well, because there has been, really since March, an inverse correlation between the dollar and risk assets. So if the dollar continues to move lower, right, that could be a positive for risk assets. Certainly could be a positive for precious metals. I know a lot of people are paying attention to things like gold and silver. So I think it makes a ton of sense to be paying attention to what the dollar is doing as well. So a lot to unpack. I think there are a lot of moving parts as it relates to headlines about stimulus, as it relates to COVID, as it relates to the election, and we can start to drill down and get the message of the market, especially if we're willing to branch out and look at other asset classes, as I do for our clients week in and week out. Hopefully people are finding that useful. If you're interested in reading my work on a daily basis, you can head over to chaikinanalytics.com and sign up for a free 14-day trial. Hope everybody is well and safe. Have a great Wednesday. Be back to you soon with some updated thoughts. Be well.